This is Bloomberg Markets. I'm John Ehrlichman. A contraction in second quarter GDP in Canada suggests the country may already be dealing with a technical recession as rapid increases in interest rates hits the mortgage market and the pocketbooks of Canadians. Last week, we saw that play out as well with some of the big bank earnings, with loan growth slowing and banks setting aside more money for potentially bad loans. For more on the outlook for Canada's economy, we're joined now by Gord Nixon, who spent more than a decade leading Royal Bank as CEO. He remains an active board member with BlackRock and George Weston, as well as BCE, the parent company of this network. Gord, nice to have you back with us. Thanks for your time.
Delighted to be with you, John.
I remember we had a conversation heading into 2023 when you talked about some of the recessionary risks. How would you characterize what you're seeing right now, how you feel about the outlook for Canada's economy?
Yeah, I think it's going to continue to remain quite challenged. If you sort of look at the headwinds versus the tailwinds, there are an awful lot of headwinds right now. Obviously, higher interest rates, the level of inflation, you've got a slowing economy in other parts of the world, China most notably. There are a lot of challenges. And, right now, the only thing in my judgment that is preventing Canada from going into a recession is our high levels of immigration. And that's certainly keeping, that combined with a fairly tight labor market, I think has been, quite a positive for the economy. But if you actually look on a per capita basis, most Canadians are not doing as well, and certainly they're feeling it, right across the country. So while immigration is certainly helpful from a growth perspective, it's not particularly helpful on a per capita basis.
And how does that impact, do you think, let's say for a central bank like the Bank of Canada, its next move? We have a decision this week. What are your views on our economy and how central bank policy fits into that?
I think given the headwinds that we face in the economy, particularly with the most recent GDP number for Canada, my guess is the bank will pause and, step back and sort of see how things develop moving forward. There'd be very little reason, I think, for, a further rate increase. I think the big issue is whether inflation starts to show signs of declining, which it is, but it's certainly not back to sort of normalized range that is acceptable to the bank. Is there a possibility for, rates to start coming down sometime next year? And I think that's, the $64,000 question. I think, personally, I think inflation is going to be a lot more challenging and stickier than people think, particularly, given the impact of sort of a readjustment of how the supply chains around the world work. That puts a lot of inflationary pressure on the system. And I just think it's going to continue to be, difficult to get back to the normalized central bank range, which means they're going to continue to be, fairly hawkish. But I think for the time being, as long as we have a slow economy, probably things will stay where they are.
It's such an interesting, unique time, really, because we have these short-term questions, but you alluded to some of the long-term factors we have to consider with a matter like inflation, if the geopolitical landscape and changing supply chains impacts that. You also mentioned the number of new Canadians, and I think while that is a positive for the economy, this issue that we have long struggled with in this country of productivity, how do we tackle that over the long term, Gord?
Yeah, I think you've got to continue to invest in those areas where you've got competitive advantage and you have the ability to compete on a world stage where you can, drive export opportunities. I think it boils down to, what broadly might be defined as industrial policy, and I think that's something that's clearly lacking in this country. We tend to focus on, politically, popular, areas. Rather than, tough areas. A good example is, climate and energy. There's no country in the world that has an opportunity to get the appropriate balance between energy security, energy opportunity, and climate. Yet, we seem to, bounce from pillar to post rather than have a well-defined, sort of policy around energy security and energy opportunity lumped in with climate. And, I happen to be in Europe this summer, and meeting with a lot of political and business leaders, and the energy security combined with climate, national security, and other areas like supply chain are sort of front and center. They don't get a lot of attention in Canada, and national security obviously being a huge one given the war in the Ukraine. They don't get a lot of attention in Canada just because of the where we're located, our proximity to the U.S., et cetera. But I think that developing having a strong industrial policy that drives the areas where we do have competitive advantage, where we can compete, is the only way we're going to get our our level of per capita productivity up to levels that are necessary for the economy to appropriately grow.
One area that does get a lot of attention is housing. But again, this issue of housing affordability escapes many Canadians right now at a time when you look at the housing prices in this country versus other nations and this higher rate environment. And a lot of people wonder what comes next. You've talked with us about your own views on housing in the past. What is your current view?
Yeah, pretty much the same. I mean, I think that housing is going to continue to be okay simply because we do have high levels of immigration. You've got more people moving into the country, particularly in the urban centers. But it's a huge drain in terms of overall economic activity, because as these mortgages continue to get reset, most houses are paying way more for interest, whether it's on their mortgage, whether it's on their personal loans, their credit cards, same things with corporations as well. So I think housing will be okay in terms of price levels, et cetera. But it continues to be a fairly, big drain given the level of debt servicing that is required for most individuals in this country. Again, you have talked about productivity. I mean, one of the reasons that we have had good economic growth is partially because we've had such a strong housing market. That's a good thing, but you'd rather have much greater growth rather than in residential real estate in areas like technology, in areas like healthcare, in areas that are more important in terms of driving long-term growth in an economy. Ours has been very much driven by areas like residential real estate and the residential building, et cetera. So I think that shift is going to be necessary over time. But I think real estate will continue to do okay, but puts a lot of pressure on individuals.
Now, getting to the banking sector, which you know very well, and obviously is watching the trends with housing as well, there's a lot going on. We talked about preparing for potential economic downside, but we're also seeing a time when there is a window of consolidation. Obviously, we saw Royals deal with HSBC. There's obviously some questions about what might happen with Laurentian Bank. How are you thinking about how the road ahead, if you will, for Canada's banking sector?
Yeah, I think the sector, well, first on consolidation, I think that, those are two deals. It's more coincidence, I think, that they're happening at the same time, because the fact of the matter is there's not a lot to consolidate in Canada. HSBC was the big opportunity, and that one seems to be taken, or at least at this point in time, it looks like it will be. Laurentian, remains a wild card as to whether or not it trades, but on a relative basis, it's extremely small compared to the overall sector. There's just not a whole bunch to consolidate, which is why you've seen most of the expansion of the Canadian banks outside of Canada, whether it's in the U.S. retail banking side or the wealth management business. So I think it's more coincidence that HSBC has traded at this point in time. I wouldn't expect to see a lot of consolidation. In terms of performance, I think it's going to be steady as she goes, but it's tougher. You've seen 5 quarters of provision increases across the banks. The good news that is if we are able to manage a soft landing, there should be not only a reduction in provisioning, which will make numbers next year look better, but you could also see some reserves being released if the challenges are not as great as the provisions call for. But it's going to continue to be tough. I think the banks are going to have to take tough action, much like we've had to in the past, and I think have stepped up and done it. But, cost structures at the banks are in really bad shape right now because they've all grown and expanded over recent years, and with inflationary pressure, and now wage pressure, the banks are going to have to significantly come to terms with their cost structures. I know a number of them, including RBC, announced or made reference to that in the quarterly calls, but I think a lot more is going to have to be done in terms of managing their cost structures and getting their performance back to reasonable levels, because they've really flatlined now for quite some time. Certainly their share prices over the last couple of years, but even over the last 6 or 7 years, the performance has been fairly anemic. So, I think that it's a tough environment, but they're going to have to take some steps. But I think going forward, they'll do just fine.